Hello, I'm Eric Mancini, Director of Investment Research and Wealth Advisor at Trapeg and CPAs and Wealth Advisors. And today we're going to be going over a new investment we've made in private credit space, Cliffwater Enhanced Lending Fund, or ticker CELFX. And then also a brief look at, just because of timing, on the new legislation that's likely to pass very soon, which is the Inflation Reduction Act. So we'll start off with a brief overview of a little more detail we're going to be looking at. So we're going to look at, again, why we're looking at these alternatives, and more on the private credit side than public bonds or public fixed income. We're going to look at exactly how this fund, CELFX, is currently allocated amongst different asset classes. We're going to be looking at some of the explanations are more of a description of what exactly these asset classes are. We're going to look at historical fund returns and our outlook for the fund going forward. And then again, as mentioned, just a brief thoughts on the Inflation Reduction. So, why are we continuing to look for opportunities in the private credit or alternative space is really this, just the yields that you could get on traditional fixed income still. Now, they have increased over the past, especially this year and some last year from where they were, but they started off at extremely low levels. The 10-year Treasury got as low as 0.5% yield. Now they are up materially, so they're up to about 2.8% as this is being recorded. And that's why we did, for some select clients, actually for the first time in a couple of years, get back into bonds to some degree. Just because if we could get a high quality 3, 4, 5% from a combination of treasuries and investment grade bonds, and have a somewhat of a hedge against a slowdown or recession, for a smaller portfolio, we think that's prudent, so we did so. But overall, we're still heavily underweight traditional fixed income and more overweight these private credits and alternatives. And again, this is a chart from 1982 to 2022 this year, the 10-year Treasury yield. So back in the 80s and 90s, if you bought a 10-year Treasury, you would have made somewhere in the 7.5% to 13% per year range for the next 10 years, as long as you held that to maturity. So those were pretty sizable yields or total returns for, as long as you hold to maturity, a risk-free rate. From the very early 90s through just after the Great Recession, you had a pretty steady decline in rates. And for the past decade or so, we've been stuck in an area where the 10-year Treasury has yielded anywhere from 0.5% to 3.5%. And now we're in the middle to the upper side of that range currently. And, when you look at it a little more, specific, so this is just a simple look at you buying a 10-year Treasury in 1982 versus 2022. And if you bought one in 1982, you would get a guaranteed 10% per year return as long as you held that to maturity, with a risk measured in this case by duration of 6.3. We'll get to duration in a sec, what that exactly means. In 2022, now you're getting 2.8% per year instead of the 10% in 1982, and the risk is now 8.7 versus 6.3, again measured in duration. And the way we measure risk of a high quality bond is the approximate bond value loss or gain with a plus or 1 minus % change of interest rates in a year. So for example, if you bought a 10-year Treasury now with an 8.7 duration on it, and interest rates went up 1% in 1 year, the value of your bond would have gone down approximately by 8.7%. And the same is true with 1982. So there, if you buy one 10-year Treasury, interest rates go up 1% about in 1 year, then your bond would have gone down about 6.3% in value. So when you put this together and we're building portfolios, somebody was building a portfolio in 1982, at that point they were getting 70 to 75% more return on this bond with about 35 or 40% less risk. And obviously the reverse now. So the risk return for a 10-year Treasury has really changed materially in a negative direction over the past 40 years. And that's why we continue to be underweight significantly, even though we had added a little bit on recently. But, with this change in dynamics, we continue, and we would think we would continue to be underweight traditional fixed income for a long time to come. So that's why, we continue to be where we are. And in our search for good options for alternatives to traditional income, we found CELFX, which is the same company. It's Cliffwater Fund. We already held their middle market lending fund. And what this fund, it is different than that, and it's different from any other fund we hold in the portfolio. And this sort of gives you an overview of a couple different areas we look at when investing in a fund. So this is a diversified private credit or private debt fund. And you'll see a couple highlights here. So, one thing we always look at is experience, how long they were doing this, the management of the company. Did they just get in it a year ago? Have they been doing it for decades? So they have been doing it for about 15, 16 years. Cliffwater started to invest in what they call enhanced lending since 2006 and have a track record since then. They manage into billions of assets. It's a large company, deep pool, and they have 22 people on their team. So then we look at the design of the fund. So this has a lot of flexibility. So there's many different asset classes they can invest in. If they see more opportunity in this side, they can invest there. If they see, if they have a large allocation, but then opportunity is waning, they could sort of peel back on that, invest somewhere else. So they have the flexibility and the knowledge to invest in many parts of the private debt market. And by doing this, by investing in several different types of private credit, they're combining in one fund many unique, non-correlated risks into one fund, which is good for risk management, of course. So if something happens in one of the sections, it has nothing to do with anything else in there. And that's a strong risk mitigation. And then in terms of performance, even though they've been doing this since 2006, they just brought this strategy into this fund form recently. So this is about a year old, this fund in its current form. And being 1 year old, they're up 14.1% over the course from July of 2021 through now. And year to date in 2022, which we all know obviously was a tough year for stocks and bonds, this is up actually 7.45% in 2022. This is one of the best performers in the portfolio. And again, another thing we're looking for, because this is replacing high quality traditional bonds, is low volatility. So we want it to be very low, ups and downs, very steady, and minimal correlation to risk assets and even other bonds. So this really, no matter what the stock market's doing, no matter what the bond market's doing, this will tend to have very little relationship to any other market. And this is how, as of now, these will change, these numbers, but as of now, this is how the fund is allocated. So there's a total of about 700 million within the fund currently. They work with 18 different partners underneath that are sub-managers essentially. So they're well diversified amongst many different private debt managers. And they have many, many, many different credits, and the hundreds, if not thousands, of different specific credits within the fund, where you could see the average position size is just about 0.1% of the entire portfolio. So there's diversification not only in asset class, not only in manager, but of each specific credit as well. And all those are risk mitigation. Now, what are these invested in? So the biggest chunk right now is in what's called asset-backed or asset-based lending. We'll get to that in a second. We'll get to the definitions of all these in a second. But 24% in asset-based lending is the largest chunk. Then you have 19% in specialty lending, 14% in real estate debt, pretty self-explanatory, 13% in rediscount lending, 10% in venture lending, 10% in mezzanine or structured capital debt, and then another 10% in miscellaneous or other. So you can see very diversified amongst many different things. There's not one section that's taking up a very large chunk, and each one of these has very little to nothing to do with one another. So as we get into what are exactly some of these things, so asset-based lending is, an example of this would be if we're making a loan to call it a mining company, that the loan is not backed by the company overall or the cash flows of the company. It's specifically backed by one asset that the company has. So if they have a large truck that's say worth $1 million, you could easily sell it on the market for $1 million to somebody else. We'll make a loan to them for $500,000, and if they don't pay us back, then we just take possession of that truck, and then we could sell it, get our money back. So these are 100% backed loans with a specific asset backing them up. which certainly provides a level of safety to those type of loans. Specialty direct lending, as it says here, it's making senior secured credits to companies with a non-traditional profile. So it could be a smaller company, mid-sized company, companies that don't have a particularly stable, the earnings may go up and down a significant amount, and therefore from a bank it's tougher to get a loan. We will loan them that money, but again, these are senior secured, and we're going to charge a pretty high interest rate for that loan. And then real estate debt is the third largest section here, and this is more self-explanatory. So this would be loans used for either development, construction, improvements on a piece of real estate, and of course it's collateralized by the underlying real estate here. Again, first lien, usually in that sense. And those are your three biggest chunks, which represent almost 60% of the total fund. And then I put on some smaller pieces of the puzzle here. Venture debt is lending to very high growth, smaller, usually private companies, may or may not be profitable. So you are taking more risk with these, but then you get a large amount of return. And again, this is a smaller portion of the fund. And then somewhat similar to our other fund, NICHX, Variance Private Debt Fund. They also have some exposure to royalty credit, which is content producers, intellectual property rights that are making loans in exchange for royalties, either forever or for a period of time, and then litigation claims as well. We're giving money to a future settlement to a law firm in exchange for a future settlement. So all these different things are different from each other. If something happens in litigation claims, has nothing to do with asset-backed lending. If something happens with specialty direct, nothing to do with real estate debt. And none of these, there's no overlap of any of these to any other fund we have in the portfolio. And then to look at, again, even though they've been doing this in the same strategy since 2006, the fund was incepted just last year, so a year ago in July of 2021. And this is a chart from inception. So this dark blue line on the top is the total return of the fund, CELFX, over that period of time. And as you can see, it's extremely low volatility. There's no correlation to bonds, which is this line here, the bottom line, which is the total bond index or the bond aggregate over that same period of time. This is the leverage loan index. You could sort of ignore that one. That's not that important. It's really comparing, we're replacing this traditional bonds, the bond aggregate basically, with this, where we're not subject to interest rate risk, we're much less volatile, and certainly the opportunities for higher returns. And as you can see, it's a young fund still, even though the strategy they've been having since 2006, where to date they have not had a negative month yet, despite 2022 being a very challenging year. So no matter what the stock market was doing, the stock market was down 25% for a period of time once we got to mid-June. Even the bond market was down 10 to 15% in this time. And it didn't affect this at all. As you can see, as the bond market, as interest rates went up, bonds came down materially. So in this period of time that's shaded on the chart, the bond aggregate, if you held a combination of investment grade bonds, treasuries, you were down about 12% in about 6 months. So that's a large decrease for bonds in that amount of time. At the same period of time, this fund returned a positive 6.1. So absolutely no correlation here during that period. And then going forward, our outlook for their fund, we continue to view this along with our other private credit funds as a really nice replacement for cash, treasury notes, investment grade corporate bonds, and high yield corporate bonds as well. Just when you look at the risk return profile, the correlations, the volatility, it seems like this combination of, and to date, the proof's in the pudding here, these private credit, these private investment, these alternative funds have just a superior risk return correlation profile than especially bonds in the current environment. So we think that continues. We think that high quality bonds now, if you buy a 10-year treasury, you're getting 2.8%. Investment grade, maybe you're looking in the upper 4s to about 5. This historically has, over the past years, returned 14%. We don't think that continues. We think that's certainly high. But we do think that something in the upper single digits is certainly possible going forward on an average basis, somewhere maybe between 7 and 9%, something like that. All categories of assets, again, as I went through before, function and or go up and down and are affected by completely different things. So they operate completely independent of one another within the fund with no correlation. That's risk reduction. And then overall, this fund in and of itself has nothing to do with any other investment in the portfolio, which is another form of risk reduction, and that's what we look for. And then, finally, the returns. We think there'll be excess returns there going forward versus traditional. Traditional bonds. And right as of now, not to say this is not a guaranteed return, this is not the expected return, but the fund is, if all the loans, perform as intended, it's accruing interest or returns at the rate of 10.2% per year. We think there'll be some amount of defaults or whatever else, so we think that drops to 7 to 9% average, but still, it's a nice accrual rate, nice interest rate. You'll expect nice returns, and it's a nice complement to our other private credit funds, CELFX, which is the same company, Cliffwater, Lendex, which is Stone Ridge, and NICHX, which is Barrier. And then lastly, a switch of topic here, but it is timely, so we thought we'd just tack this on as it is, important, and we're getting some questions on it. So the Inflation Reduction Act was introduced about a week ago. It's most likely, almost definitely going to get passed at this point. So we thought we'd go over what's in there and what we, how we view this in terms of portfolios or specific investments. So what's in the bill, and it should be pretty close to final now, is about 300 or so billion in clean renewable energy subsidies and incentives. So this has wind, solar, utilities, EVs, and actually along, it also has some oil and gas exposure there too, in an attempt to increase supply of even traditional energy, so oil and gas. So it certainly does have a lot towards energy, both the transition to renewables clean and some support for the expansion of traditional energy, oil and gas. And has a good amount, about 350 billion for healthcare reform. And this is, I think, 10 drugs or so, at least to start. And this doesn't kick in, I don't think, until about 5 years from now, 4 or 5 years. But some caps on specific drugs named in the bill. Yearly spending caps for Medicare, that would be total out of pocket, and then extends some health insurance subsidies under the Affordable Care Act as well. So that's in healthcare reform. And then lastly, you have some IRS funding or hiring support. So 85 billion is going to the IRS, and that's mostly hiring of about 85,000 new IRS agents or employees. And that's a combination for, it looks like the majority of this will be looking for increased audit support, enforcement support, along with some customer service and technology enhancements as well. And then lastly, how they're paying, or how this bill would be paying for these spending pieces, would be the tax reform, on the tax reform side. So they're introducing a new 1% excise tax on all stock buybacks. And also, for the first time, having a 15% minimum corporate income tax rate on all companies with more than $1 billion in revenue. So if you had a company, publicly traded stock, earning $5 billion in revenue, but because of certain deductions or whatever else, they were showing an accounting loss, they would maybe be hit. There's some carve-outs, there's some exceptions still, but this will affect probably somewhere in the neighborhood of maybe 40 to 60 different companies that would be hit with this 15% minimum tax, where maybe prior they were paying little to no tax. So when you put all this stuff together, we've researched, we've worked with a couple different groups, nonpartisan groups that look at this and say, put all this together, expand out. We and they, feel this will have little impact on the overall economy, or maybe a negligible negative impact in terms of the stock market economy over the next 1 to 2 years. The two groups we look at most saying maybe this has a hit next year of 2 or 3% in terms of corporate earnings, S&P earnings coming down a little bit from these tax, mainly from the buyback tax and the 50% corporate minimum tax. So that might take a small hit at 2 or 3% off earnings on the S&P. And also in terms of economic growth, this may have a very slight 0.2, something like that, in terms of GDP lessening due to this. Overall, pretty negligible, however. However, where it will have significant impact is on the specific, target industries that it's going for. So clean, renewables, electric vehicles, certain utility companies, even some traditional energy, oil, natural, especially natural gas, they will have a benefit from it. There's no question about it. With subsidies, all this cash flowing in there. And we've seen these type of stocks react very favorably. And then on the healthcare side, it's mixed. So some pharmaceutical drug companies might have a little bit of a negative impact. Some insurance companies would have a positive impact. And where we think this has the most impact, direct positive, would be on the clean renewables, electrical grid, utility companies. And that's where we have an investment. We didn't make it specifically for this, but between both the infrastructure bill that was passed a while ago, earlier this year, and this bill, there's a lot of tailwinds and a good amount of government funds being put into clean renewables, the electrical grid, and that's the fund we have, ECOIX, which is EcoFin's utility fund that has a heavy lean towards clean renewables, but they are holding electrical companies. So we have that fund, which we feel will benefit pretty materially from both the infrastructure and this new legislation. And that is actually up on the year now after this news. So that's what I had, for today. Thanks for tuning in. Appreciate the time. And any other questions, you could let your wealth advisor know at Trapegan or myself, and my email's at the bottom there, Eric, ERIC, @tfgllc.com. Thanks a lot.